Welcome to Sawyer Silver Vault. Imagine waking up to find nearly $750 million in Bitcoin suddenly on the move. Wallets that have been silent for years suddenly roaring to life. And the key price level that was supposed to hold just shattering beneath your feet. That is exactly the scenario playing out in the crypto markets as we speak. And it has triggered a violent sell-off that has traders scrambling for cover. If you are long Bitcoin right now, you are feeling the heat. If you are on the sidelines, you are watching a potential bloodbath unfold. Today is not just another red candle on the chart. This is a structural breakdown driven by a perfect storm of on-chain terror, institutional panic, and macroeconomic gravity. Here is what is moving the needle and why your heart should be racing if you hold exposure. First, the ghost of crypto past has returned to haunt the present. The Mt. Gox estate, the infamous exchange that collapsed over a decade ago, has just moved over 10,000 Bitcoin, worth more than $700 million, to unmarked wallets. The market saw that transfer, immediately assumed that a wave of creditor repayments is about to hit the open market, and panic sold first before asking questions later. Second, the institutions are not buying the dip, they are running for the exits. We just saw a staggering $483 million exit the spot Bitcoin ETFs in a single day, marking the fourth straight week of relentless outflows. Specifically, BlackRock's IBIT, the heavyweight champion of the ETF space, saw a massive $440 million single-session drain. This is not retail panic, this is Wall Street voting no confidence for the near term. Third, a whale just sent $103 million worth of Bitcoin to OKX, fueling fears that a big player is preparing to liquidate. Add to that the Federal Reserve's hawkish stance, with markets now pricing a near certainty that the Fed holds rates steady through the summer while sounding more aggressive on inflation, and you have the recipe for the volatility we are seeing right now. We are currently testing the absolute breaking point of the bull market structure. And I am going to tell you exactly where we go next. As we record this, Bitcoin is trading under significant duress, having broken below that psychological $70,000 handle that so many analysts swore would act as a floor. After trading in that volatile $67,000 to $71,000 corridor, the bears have finally won the battle for the moment, with the asset dropping as low as $69,950 in recent sessions before attempting a slight recovery. This represents a drop of nearly 4% on the day, wiping out weeks of consolidation gains. The price action is ugly, and the technicals are even uglier. We are currently staring down the barrel of the weekly HAL moving average, a critical dynamic support level. If that breaks, the floodgates open. So why exactly is the price crumbling if the long-term fundamentals of the halving and adoption remain intact? The simple answer is supply shock and sentiment collapse. The market is drowning in fears of supply overhang. The Mt. Gox movement acts as a psychological nuke. Even though the Bitcoin has not yet hit exchange order books, the mere reminder that hundreds of thousands of Bitcoin are still owed to creditors from that collapse is enough to spook weak hands. Traders remember 2024, when similar movements led to immediate price suppression. Furthermore, the derivative markets are adding fuel to the fire. CoinGlass data shows that we just experienced over $750 million in liquidations, with the vast majority being long positions who were betting on a breakout above $75,000. That forced selling cascades into spot prices, creating a vicious cycle. Turning to the institutional activity, the narrative of infinite Wall Street bid has been shattered for now. 3 weeks ago, assets under management for the ETFs sat near $109 billion. Today, that number has collapsed to just over $91 billion. That is $18 billion in value wiped out, driven primarily by outflows rather than just beta decay. When you see consistent multi-week outflows from products like IBIT, it signals that institutional allocators are rotating out of risk assets entirely, likely due to the realization that the Fed is not cutting rates anytime soon. The TD Securities report we are tracking suggests the Fed is about to remove its easing bias entirely, keeping rates higher for longer, which is kryptonite for high-duration assets like Bitcoin. Analyzing the market sentiment, we are officially in what the experts call a tug-of-war phase. But right now, the bears have the rope. While on-chain data from CryptoQuant shows that wallets holding between 1,000 and 10,000 Bitcoin have started accumulating again, picking up over 55,000 coins recently, the exchange inflow data is flashing bright red. Retail inflows to Binance have surged by nearly $4 billion, and whale inflows have followed suit. In simple English, the smart money might be accumulating slowly on the dips, but the masses and the anxious whales are sending coins to exchanges to sell. As long as exchange inflows outpace accumulation, price will struggle to find a floor. Looking at the whale activity specifically, we have to talk about that 1,393 Bitcoin transfer to OKX. While it is possible this is just a wallet reorganization or an over-the-counter trade, the timing could not be worse. The market is hypersensitive right now. Combined with the general rise in the exchange-whale ratio, which is at a 10-month high, it indicates that large entities are increasingly active on trading platforms. Historically, this precedes major volatility. Globally, the macro environment is tightening its grip. The US Treasury is set to settle massive new issuance next week, which will suck liquidity out of the banking system. When liquidity tightens, risk assets like Bitcoin are the first to get sold to cover margin calls or raise cash. The US dollar index remains stubbornly strong, which is a classic headwind for crypto pricing. So, what do you do right now and what should you watch next? First, understand the battlefield. The immediate support cluster is sitting between $68,000 and $71,000. Ali Charts has pinpointed that a strong reaction from the $68,000 area is necessary to avoid disaster. If buyers do not step in here with force, the next logical target is the $65,000 region, where the 200-day moving average sits. That is the ultimate bull market trend line. A break below 65,000 would invalidate the current macro uptrend and could send us testing $60,000 or even the $59,000 region. On the resistance side, Bitcoin must reclaim $72,500 as support to stop the bleeding. That level is the previous monthly low, and as long as we trade below it, the bias remains heavily short. For a true reversal, we need to see a 4-hour candle close back above $78,000. But that seems like a distant dream given the current selling pressure. Traders should watch the order books on Binance and OKX closely for the next 24 hours. If those Mt. Gox coins move again, specifically to known exchange wallets like Kraken or Bitstamp, we could see another leg down instantly. Conversely, if the accumulation addresses continue to scoop up supply and ETF outflows slow down, we might find a footing. For now, patience is a virtue. Do not try to catch a falling knife in this environment of fear and supply uncertainty. The market is looking for equilibrium, and until we see a definitive reduction in exchange inflows or a massive bullish catalyst from the macro side, the path of least resistance appears to be lower. For more videos like this, subscribe to our channel Sawyer Valut News.